Well, good day, everyone. Welcome to our Long Options webcast. I'm Connie Hill, sitting in today for Brent Moores. Usually I get to be your chat person, but today we're going to talk about long options. So I'm glad you've joined me here today. How many of you are actually a little afraid of this strategy right now? Like you're like, I don't want to trade a long option. That very well could be the case. We're seeing some whipsaws in the market. Well, we're going to talk about maybe some steps you can take to help yourself maybe feel a little bit more comfortable trading long options. And we'll get into the details of that in just a minute. I am joined in the chat by Scott Thompson. You guys probably know Scott Thompson. And he's here to help me field some questions, maybe things that I can't quite get to. He will help me out answering those questions. So fire away, send your questions in. If you're listening to this on the recording, like many of you do, when you have a question, put your question in the comments section. And we go back and review those throughout the day so that you can get your questions answered as well. Hope you're following us on X. I'm Connie Hill, CS. I see Wiley says I've got an imposter out there. Appreciate letting me know that. Maybe tell me what the imposter is listed as. So look for this to be very specific. At Connie Hill, CS. There's no hyphens. There's no extra little numbers. Okay, so look for those little things because I don't know why people like to imposter us, but they do. If you want to follow Scott, Scott actually does some posting as well. He is Scott Thompson, CS. Let's go through our disclosures and let's get down to business. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for information and education only. Don't consider it a recommendation. We will be using the Paper Money software application. This is what you can download to your computer. It is the most robust version of Thinkorswim. Has a lot of nice tools for option traders. Past performance of any security or strategy does not guarantee future results or success. Now, in this class, we want to talk a little bit about, the theory of long options. I'm hoping all of you have been exposed to long options. It's usually one of the very first strategies we learn when we're learning to trade options. So hopefully you've gone through the getting started lesson with long calls and one with long puts, okay? But we'll touch on it a little bit here today. Now, you have to know this is a very directional strategy. What does that mean? We need the stock to move. Not all strategies are that way, right? When we get into some spreads, different spread types, many times the stock can just stay where it is and we'll be okay as far as having some profits in the trade. But on a long option, man, we need the stock to move. So keep in mind, they are what we call theta negative, which means time decay can wear against the price of the option. Every single day that you stay in the trade, time is going to decay on that option. And then they're also what we call vega positive. Vega positive means if implied volatility goes up, which a lot of times with a long put they do, that expands the value of your premium. Now, if you're holding that, you're the option, you like that, right? You're like, great, anything that helps add to the premium value, we might be liking, okay? The other thing you need to know is you could lose 100% of what you put into it. Whatever your contract costs, if you spend $500 for it, you could lose 100% of it. Now, obviously, that's not our goal, right? We don't want to lose 100% of our option contract, but you have to know that it's a possibility and it is a real risk. Now, I'm going to come over here to my Thinkorswim for a minute. Because what we're going to do is just kind of take a look at the markets, see what they're doing, and have some framework in which to work. And I am going to give you some steps that we're going to follow here today. Oh man, I forgot to clean this chart up. Oh, let's go hide these for just a minute so it's not quite so busy. We'll be okay with the rest of that, all right? S&P 500. Many times traders want to align the direction of their trades with what is going on in the S&P 500. Now, today it's up. So you're like, well, do I want to chase it because it's up, right? We've had some bearish days here in the SPX, and most stocks are following that same trend. And so I can see people having a conflict and kind of being a little bit afraid to trade a long option strategy because you could lose all of it. And the stock has to do what you want it to do in order to try to be profitable in that kind of a trade. So on the SPX, something that some traders will do is they'll say, well, I want to make sure whatever the direction the SPX is trading that day, I want to make sure that I'm in sync with it. Okay. Doesn't mean you have to do this all the time. You're always going to find exceptions to that. You may have a big list of bearish stocks that you generated and watched them move back. And so you might be going, if we're having a bounce day, maybe you want to sit out. Maybe you don't want to necessarily follow along. That would be completely understandable. Okay. Let's see here, just looking here. Oh, that's just Scott helping out here right now. So I'm going to give you an idea of step one is go the same direction of what the market's doing. Okay. Because the market's bullish at this time, doesn't mean it's going to stay that way the whole day. We've seen it reverse several times, right? But because of that, we are going to look for long call opportunities versus long put opportunities. Okay. Let's take a look at our first. Oh, I wanted to look at the VIX too. Just the idea that the volatility is still in a higher range. It's above 30 here, which, when it gets about this 28, 29, 30 area, it's kind of a little bit higher volatility. And so we've really been above that ever since we had that day on April 9th or April 3rd when the market just really rallied. Then the VIX has been higher than that, and it hasn't dropped down below. We would love to see it drop down below in terms of having a market that maybe is a little bit more, not that we can predict it, but maybe not quite so volatile, not whipsawing us around as much. Can whipsaw us any day, but just know here volatility still is a little bit high. That means option premiums could be a little bit more expensive. That also could mean that maybe traders might want to do some spread strategies, but because that's not our class, we're doing long options. Okay, let's take a look at this first stock, QRB. And I'm going to bring back on, well, we'll just have a clean one here for just a minute. WRB, Berkeley WR Corp, is a stock we're going to look at here. Looks like they had earnings this morning. No, they had them yesterday afternoon, and the market's responding to them quite favorably right now. Now, so I'm going to just kind of put in here, I'm going to put in a step one that just says same direction as indexes. Now, if you're trading a lot of technically related stocks, instead of using the SPX, you might focus on the NDX, right? The NASDAQ 100. Okay. Step two that we're going to do here is we want to have an on-time signal. What does an on-time signal look like? Well, I have broken out here what bearish signals are, what bullish signals are. We're focusing on the bullish signals. So we are looking for today to see either a support bounce, a close above the high of the low day, although some people might take a move above the high of the low day, not really wait till the close, maybe a bounce off the moving average, or a breakout pattern of some sort. Maybe it's breaking above horizontal resistance, maybe it's breaking out of a flag pattern or a triangle, but we're trying to be Johnny on the spot and Jane on the spot. We're trying to catch it on the day that it occurs, okay? If it happened yesterday or the day before, some people still might choose to trade it, but we're trying to be as on time to the party as we possibly can, okay? So that's why we're maybe going to focus on those particular signals. Now, what would we say would be an on-time, let's kind of move in here a little bit, an on-time signal here for WRB. I'm going to put my studies back on here because we need one of them actually. So just unhide it, unhide. And we're going to bring back some moving averages. Though the shortest time frame is 21. Then we have that really long time frame of a 200. And then we have a 50-day moving average. Okay, so we might just go ahead. Let me bring those back. What's interesting to me is that today's price movement kind of looks like it's bouncing off that 1-day moving average. Okay, so and earnings is out of the way. You don't have to worry about it. In fact, the market's reacting positively today. In the second panel down, I've got RSI, which kind of gives us an indication of momentum. So if you're looking for some additional emphasis, some additional information that maybe the stock is going up, some people might want to throw the RSI on there as well. But what we're seeing as far as an entry, June and Johnny on the spot is looking at that bounce where it is right now. Now, there's no guarantee it's going to stay there. Would love for it to. And we're not going to be together today, this afternoon, when the market closes. So we're going to have to take some action right now. So really, I would look at this and I'd say, looks like, let's use our diagonal one here. Looks like somebody might look at this as maybe a little bit of a flag pole, and then maybe a little bit of breaking out of a flag pattern too. So we got a couple of things: flag breakout, bounce off the 21-day moving average. Okay, we're going to call that our on-time signal. Next up, step 3 is we've got to choose some time. We've got to choose a strike price. For our time, we want to make sure we have absolutely enough time. The approach we're going to take today is that we don't want to be in the trade very long, but we want to make sure we have enough time for the stock to move and for time decay to not kick in heavily, right? The last 30 days of an options life, time decay kicks in just heartily, okay? We're going to try to put a buffer on our trade for that. So we're going to go out a little further in time. We might look at some June options. We may actually look at some July options. As I would say, the May options are probably too short, unless you're somebody that's very aggressive and you really like trading those very shorter term type options. But I wouldn't consider that a conservative approach. I'd say that's a more aggressive approach, okay? I would love to see a lot of open interest out here in June, but we're just not seeing it, okay? So if you don't see it, just go out to the next one, all right? So in this case, we're just going to go out to July. And honestly, the price is not a ton different. This 70 strike price is 370 here, and it's about 440 here. Okay, so less than $1 difference. Now, we're buying enough time. We're gonna focus on July here. We've got some decent open interest, so we feel comfortable with the number of contracts. And then we're going to use the delta to help us. What we're going to look for in the delta is we're going to look for something that has at least a little bit of intrinsic value, okay? Maybe it's a 55 delta or 60 or 65 delta, something in that range that maybe cuts our exposure to time decay, at least in some regard, all right? So in this case, looks like this is kind of an odd strike price here too. The 69.50, usually we might expect a 70 there. They must have had something going on where they had some, maybe a merger or acquisition where they brought in some additional strike prices for what they did as far as maybe a restating, because those are a little bit, I'm going to say weird, not normal. Usually we'd typically have a 70 there, not a 69.50, but we've got plenty of open interest here, okay? And it does have something greater than, a decent delta, a little bit in the money, okay? That's certainly higher than 0.55. So we are going to run with this 69.50. So the next step, I forgot to put that this was step 2. So step 3 is the delta, okay? So time is kind of a natural, make sure you have enough time, but the delta, we're going to look for 55 to say 65 delta. Now, if you have something, a 70 delta, it doesn't mean, we better bag it because it's not in this range, okay? Just kind of giving you a guideline of as far as what's a little bit in the money, that 55 to 65 delta, all right? And I forgot to put 3 here, so we're going to go step 3 is that. And the next piece is to kind of help give us some comfort so trading those long options aren't so scary. We're going to put in some exit points, okay? We're going to just look for little moves here. We know the market is whipsawing us around. We don't plan to be in this trade for a very long time, especially when the overall trend of the market's been a lot more bearish than bullish. And so we're just going to put in an exit where we have a little bit of movement that we might be happy with. And, you know, if it does it the first day, great. If it does it the second or third day, great. We're happy campers about it. But then we want to get out. So we're going to put that exit in right from the get-go. So we're going to go ahead here on this. We're going to hope we get filled kind of at that midpoint price. So, you know, maybe it comes in at 430 or, you know, maybe 425, something like that. We're looking to get in a little bit cheaper. And if the market doesn't give it to us, we'll go ahead and change our entry point there. Okay. So here, let's put in, and we're going to be consistent with this in our lesson, the different trades that we see. We're going to follow the same pattern on every one of them. So for a profit exit, we're going to put in 30% greater than whatever this price is. Okay. We're also going to put in an exit. So we're going to say, we're going to make this be a first triggers OCO, and we're going to put 2 exit conditions in here. So we're going to say, here, we could lose all of it. We could lose all 425. In my paper account that we're working with here, we're willing to risk up to $1,500. But if maybe it's a position that you're not super comfortable with because maybe the overall direction of the market, or for whatever reason you have, maybe you do a smaller position, okay? And you say, okay, we're not going to trade 3 contracts. Maybe we're just going to trade 2 contracts, okay? So we're going to step back a little bit. We will go with 2 contracts, and then let's create 2 opposite orders here. Now, the first order is going to be the target with a profit, okay? So I'm going to put here, let's see if it's, I was going to say, let's see what the most recent price is. Okay, so maybe we can get it at 440, not taking the full midpoint of the spread there. So let's take 440 and multiply that by 1.3. That'll give us a value that's 30% greater. If we can go 30% from 440 to or 425, whatever we end up paying, to say 572, fabulous. We're going to take it. Now, so let's go ahead. We're going to put that order based on the price of the option. And we'll leave it at a limit. We're going to make this good till canceled. We'll also make this second order good till canceled. Now, let's talk about an exit if things fall apart. What if tomorrow news comes out, the whole market moves down, any bullish position that was rallying today gets squashed? We want to be out as well. Okay. Some people might put, if they said, well, I'm looking for a 30% gain, maybe I'll put a 30% loss for my exit. Okay. And you could do that, but sometimes that might be a little tight for option pricing. You may have noticed this when the market opens up first thing in the morning, it'll jump around a lot. And it could be that if you have kind of a tight stop, it could knock you out of the trade. And so for that reason, some people might say, well, I'm going to back off that value. So what we're going to do here is we're going to actually risk a little bit more than what we're looking for on our gain. That's not necessarily a normal thing. So I want to point it out. It is a little bit more risky. Okay. So what we're going to do here is we're going to say, okay, if this goes against us, say 40% and only 60% is left, let's get out. Okay, we're not going to put it at a 20, 25, 30 that might just kind of knock us out. But if it really goes 40% beyond, then more likely than not, it's going to continue to go that way. Okay, so we recognize that's not normal. So let's put in our 440. We're going to multiply this by 1.6 because if 40% is gone, only 60% is left. And I went the wrong direction on that. Let's try one more time. Let's go 440 times, not 1.6, we're going to go 0.6, okay? 40% would be left. That says, okay, get out at 264. Okay, so we're going to just put both of those conditions in there. Whichever one it hits first, that's the one that's due to execute, should go out and cancel the other one. So if it hits that target, great. it'll cancel our stop loss. We don't want to be in it anymore when we're out of the trade. And so that's why we're doing this, whatever OCO order, first triggers OCO, whichever one it triggers, that's the one that's going to be executed. Cancel the other one. All right. Now I'm just going to look at the chat real quickly to see if there are specific questions about this trade and things that you're looking at here. And I think really Scott has just been busy answering your questions here. Let's go ahead. We're going to submit this trade and we're just going to hit confirm and send. Now, what I did not write down, I made a mistake here, guys. I've got to fix that. ARD. I forgot to change it to a stop. I put it as a limit. Darn. Okay, so we're going to come up here to our order. And what I'm going to do is I'm just going to say create duplicate order. Oh, we're just going to do it again real quick here. First triggers OCO. We had 2 contracts. The price is a little nicer. Create opposite order twice. Opposite order, all right. And this last amount we said would be 264. This is where I made the mistake. I forgot to say that as a stop. Okay, stop based on that price, and then of course GTC. Let's fix this GTC. And 4.25. We'll go 4.25 times 1.3 to get 30% greater. And this may be a little bit different than what it was the first time. We're going to put it in at 5.50. I think the first time it was 5.4. It's changed just a little bit. Let's go 5.5. Just looking at my decimals there. All right. Get this in the right field, and this we're going to come back. All right, there we go. So if it goes 30% higher, 550. If it goes 40% lower, hit the stop loss. Okay, we are in good shape now. And I know this number's been floating around a little bit. Let's go ahead and see if we can get filled maybe like at that 425. Let's see if the market will be nice to us. Paper may will be nice to us. There we go. We have our fill, and we've got our stop loss order sitting out in the working orders. All right. Volume and open interest, which I am kind of a stickler for. I really pay attention to it, which is why I have these 2 columns always up on my screen. Okay. So if we were looking, say, to be less than that, let's say there were 100 contracts, 4% of that would be 4 contracts. Okay. So if we're looking for 2 to 4%, 2 to 5%, something in that range, then maybe we're comfortable at 2 contracts. Okay, out of, say, if there was 100 open interest. So we've got 140 here, 202 there. Just noting our delta changed a little bit. It started at a 0.6, but I imagine it'll be there soon. Okay, so that's what we're looking for here. If you're somebody who likes to trade 10, 20 contracts at a time, you might want to look for more open interest than what we're seeing here on this trade. Okay, appreciate the question. All right. Yeah, so Frankie's wondering, yeah, so we did it as a 30% gain on our target and a 40% loss on our stop. Now, in an ideal world, we just don't want to get ticked out on a stop loss if the stock's being kind of volatile at the end of the day or volatile at the beginning of the trading day. So that's why we're giving it a little bit more cushion. All right. Next up, Wiley says, I found this stock from my growth scan. Wiley, you nailed it. I think it was my early morning movers bullish scan this morning. I think you're right. In fact, I may have posted about that too. Okay, let's size up one more here. And we'll go a little bit quicker this time now that we kind of know what kind of rules we're working at. So what I need to add here in step 4 is put in your defined exits. Okay. So I'm going to put in exits at time of entry, meaning you're not going to fly by the seat of your pants. You know exactly what you're trying to achieve. You know why you're using 30%. You know why you're using 40%. and you put it in there to get started with. Okay, next stock up. Let's see how this guy is looking here. He was looking quite lovely earlier today. Stock that has been on a downtrend, but it's found some support. And what is it doing? It's starting this process of putting in higher highs and higher lows. Okay. Today, what I'm seeing, I'm going to kind of maybe move in here a little bit more. It's nice that the RSI is above 50. It doesn't have to be, but some people like to see that momentum being swung that direction. Right now, it's above the 70, so it's in this area we call overbought, which is not a bad thing. It just means buyers are in control. And what I would see here is I would see a little bit of a flagpole. So I would say this looks like the flagpole. Sideways today was, or for the last few days, looks like maybe it was a flag in a stiff breeze, right? Your flag, if it's all windy outside, it kind of flies straight versus drooping down. And I would say for the moment, it looks like it has broken out of that. Now, it's not guaranteed to stay there, right? We've got quite a bit of market before the market would close. So we're not guaranteed it's going to stay there, but it meets the entry right now. So it is going to be our on-time signal, that flag breakout. Now, many times on a flag, we'll use this flagpole as the measuring post as far as where we're expecting the flag to go to. In this case, we're just identifying it for our entry because we're going to use that 30% as our entry. All right, so let's look at this. Let's look at June options here. Well, is there a great liquidity in the June options at this slightly higher delta level? There isn't, okay? But if we collapse that and we look at July, we're like, fabulous, July has a lot. So we're going to focus here on our 50-something delta to 60-something delta. Now, this is a 58 delta. It would be nice if it had intrinsic value as well. This particular one doesn't have intrinsic value. You can see doesn't have that dark shading behind it. And so it doesn't have intrinsic value. Now, this one, let me just look real quickly here. It's an $89 stock. So it is a little bit on the expensive side, this contract. But I put on our rule, we're looking for a 0.55 to 0.65. If you don't have it, you pick something that's close, okay? We're going to pick the 64 delta. Now, this is an expensive option. It might not work in everybody's account because it is so expensive, okay? Let's see, somebody said they have earnings on the 29th. I think that's a great thing to take note of. Yeah, you want to be aware when they're going to have earnings. Very well could be that we're in and out of this trade well before that earnings date comes along. At least that's our intent, okay? So let's go ahead. We're going to go with this 85 strike price, 64 delta, 50-cent wide spread, but we might be able to get it a little bit cheaper, right? It's got our midpoint price here about 16.20. So we're looking for the market to help us out a little bit. Sometimes paper money is nice to it. Sometimes it isn't, okay? We don't want to get too greedy, but maybe let's go down to 16.10. Maybe it'll be even slightly nicer than a tiny bit. Okay, we're going to say we have our what? We're going the same direction the SPX is going right now. We have our on-time signal, which is the breakout of the flag pattern. We're looking at a 55 to 65 delta, and we're going to put in our exit points here. Okay, so again, we're going to do another first triggers OCO. We're just going to do one contract here. It's an expensive contract. Okay, create two opposite orders here. Oops. Let's just make that a sell as well. There we go. Our two sell orders there. So we're going to do the same thing. If we can get a 30% little jump in the price, we're not going to be greedy. We're not looking for a home run. We're looking for just kind of a little small movement. Okay. So what is, let's go 16.1 times 1.3. That'll give us 30% higher for the first exit order. That's going to put it in here at $20.93. Let's make this good till canceled. We'll make both of those good till canceled. I'm going to go change this to a stop right now so it doesn't escape me. And then here, same thing. some people might want to only risk 30% on the downside, the exit, if they're only risking 30% on the top. Sometimes that can be a little bit tight, so we're going to widen ours a little bit, okay? We're going to say when 40% of it's gone and only 60% is left, that's what we're going to base it on. So we're going to take our 1610 times 0.6. That's going to give us 966. That will act as our stop here. 9.66. All right. We are going to send it in. You might make a note to yourself that when it has earnings, because you might want to be out at that time. And I don't know if you do some of the practice example trades that we do in our class, but these can be things to really help you get comfortable with strategies if you do them in your paper money account. And then, Brent typically teaches this class and follows up on the class example trades, so you can see the management piece of it too. So if you're trading it in your paper trading account along with us, sometimes you'll get some questions. You're like, I'm going to ask this question next time we get together in class because we're going to look at the trade. Okay. So I am going to encourage you to do that. All right. Next up, I want to show you a couple of new things that you will see when you are a subscriber to the webcast. Now, Scott has already shared with you a little bit, but I want to kind of give you a quick visual here. In the bottom right-hand corner, you should see a blue subscribe button. When you click on that, and just do it once, it will subscribe you to our Trader Talks Schwab Coaching Webcast channel. It's a big mouthful, I know. But when you do that, then it just makes it so much easier to find our content. You can look up specific playlists. And what I wanted to point out to you here is a couple of things that I've been doing more specifically, okay? I've been doing some short videos to help you learn Thinkorswim. They're very short. You can see my longest one is 3 minutes and 49 seconds. On that are my early morning movers that I like to post about out in my X account. And most mornings, I will post what's going on with the bulls and the bears sometimes if we're seeing a lot of both. So a lot of you have asked, how do you make that scan? How do you do it? So that's what these two short videos are telling you about. The new walk limit order, you can see how that works here. We don't have it on our display or our demonstration account, so we can't show it to you in our classes, but I was able to do a little short video for you there. And then just how you create groups. Now, a new section that's been added out to our channel is something called shorts. And shorts are just like small time frame videos. Okay, same thing. 2-3 minutes is all they are. And we have a few that we just barely published that are getting some great traction here in terms of how to use the market forecast study, which we talk about sometimes. What is the trend short term? What is the short term lows? What is the intermediate trend? What is the long term trend? Sometimes it can be helpful to just kind of have a little summary of what that really means. So that when you're analyzing your charts, you're like, oh yeah, the long-term trend is this, short-term trend is more like this, okay? So take advantage of those short videos as well. All right, let's head on back here. I'm gonna take a look at another stock here. I do wanna do something here real quick. Just wanted to see if our market was falling. According to the SPX, it is starting to give up some momentum here, isn't it? If you were to see something like that and you thought, the momentum isn't as strong as it was an hour ago when I did my analysis for some trades, you might consider maybe pausing on it. And with this next trade, I'm going to give you an extra something to look at that we could include as a fifth step. It's not something you absolutely would have to do, though. Okay. This one, we might look at just a couple of charts here to see how well they're holding in here. Here's Dollar Tree that is maybe on Thursday it broke through the resistance. It might depend on where your resistance line is drawn, if that was definitive to you or not. Yesterday looks like it gapped up a little bit, and even a little bit today, although it's definitely off its highs. It has, I'm going to say, probably about average volume right now. When we see a breakout, we would love to see extra volume, right? 30% more, 40, 50% more plus, okay? We would love to see that. It's earlier in the day. Could it get there by the end of the day? It could. Some stocks that are pretty liquid sometimes have a hard time generating 1.5 times extra volume, okay, for their breakouts. So this one, not everybody would feel comfortable with, but I'm seeing it break some real significant resistance above that 77 area, okay? That is going to qualify for our on-time entry. Where did my rules go here? I think they got moved a little bit. All right. Is it the same direction as the SPX? Yeah, it's looking similar, right? Is it an on-time signal? Yes, it's a breakout today signal. We don't know if it's really going to close there, but right now it's looking like it is. Okay. So we're going to go to the trade tab here. And on this particular one, this has quite a bit of trading activity. And so we do have some weeklies in here, but we're going to go to the June contracts. We're going to buy plenty of time. We're going to look for a 50-something or 60-something delta, so we have a little bit of intrinsic value on the option. So here we've got a 57 or a 68. All right. For this, we're going to just go ahead with this 80 call. All right. It's going to run us about 7. Maybe we can get it for 780, right? Maybe get it a teeny bit cheaper. Move that price down. And we're going to do the same thing here. We're going to put in our target and our stop, right? So again, we're going to change this to first trigger sequential, create opposite order, create opposite order again. And hopefully you know what the process is going to be here. For our exit, we're going to put in a 30% move on the price of that option. Right now, it's looking like maybe the natural price is even 780 now. I guess it's not, but we'll stick with 780 there. 30% above 780 is going to be what? It's going to be $10.14. And we're going to raise that actually to, let's go $10.15. Just round it up to the next nickel. Make both of these good till canceled. And then we'll keep that at a limit order. And then here we're going to put in our stop loss. And remember, when it reaches that price on the option, it triggers the market order. We don't know what the market's going to be paying at that point. We just know we need to be out. So the same thing, we're going to risk a little bit more on our stop than we have on our initial gain. One thing I should mention to you is you don't have to keep the stop loss here. If the stock makes a decent move and moves up, you certainly can increase that stop loss. Okay, we'll just go with the one contract here. But if we have 70% or say 60% value remaining in the stock and 40% is gone, we're going to take that 780 price. We're going to put the exit order here. We're going to put it at 0.6. We're going to multiply it by that. And the value we get back here is 468. I'm going to raise that actually to 470. Sometimes some stocks don't trade in penny increments, so I'm going to just have that aligned with the nickel increments here. All right, this is going to be a GTC. So we've got both of those good till canceled. Okay, so actually the same process here. Now I'm going to show you a step 5. This step 5 is not necessary. You don't have to do step 5. Step 5 is for people who have the time to do this, have the time to wait, have the time to look for this signal. And not everybody will. Sometimes usually we look at daily charts, right? We're looking at what is that signal on a daily chart. This is a 6-month daily. What I'm going to show you is going to be a shorter time frame. It's going to be an intraday chart. Again, not everybody is going to want this step in with the process, but it could be something you might want to look at, experiment with. All right, we are going to change our time frame here to a 1-day 5-minute chart. Okay, 1 day, 5 minutes. What are we looking for in this 1 day, 5 minute? We're looking for some very specific things. Now that this is a 5-minute chart, this green line that was a 200-day moving average is now a 205-minute chart. Okay, time frame. And the red is is a 50 periods of 5 minutes. And the 21 is 21 minutes of our 5 minutes here. Okay. So if somebody wanted to, and they wanted to be super specific and just kind of try to align every single star in their favor, what somebody could consider doing is making sure on this 5 minute chart that the price is above all of these moving averages. And on the RSI, maybe looking for something 50 or higher. If it's 50 or higher, then it gives us some idea that the momentum is swinging that direction. Right now, this is at 41. So if we were looking for step 5 to fine tune our daily entry, for those that have the time and want to go that extra step, you could add that to your process. Okay. I'm not suggesting that we trade on the intraday chart. I'm not suggesting that we just only use this 5 minute chart. Really, your main signals come from that daily chart. So I want to make sure we're clear with that point. So on this particular trade, if somebody were implementing that step 5, and I'm just going to call it above moving averages, okay, on a 5 minute chart, we're going to look for that only if somebody wants to go the extra distance, okay? But it's not, I would say, make sure all of these are in order, okay? And then if you wanted to add that extra step, you could. If that were the case, we wouldn't take the dollar trade, right? Because it doesn't meet that condition. If I had the time to sit there and watch it, then maybe I would, okay? But if you don't worry about step 5. Just make sure you've got steps 1 through 4 in line. So I've repeated that several times, hoping to emphasize that point. Now, I didn't notice this before, but I am now noticing that we have a survey out in the chat. And so you guys know that have been with us before that in the chat, sometimes we'll throw out a survey. And we love to have your feedback. Anything you write in there, I'm going to read every word. Our manager's going to read every word. Scott's going to read every word. We want to know what you say. And so really it's to give feedback on this specific session, not sessions in general. Okay, so this specific session. And it's really easy. Two radio buttons, plop, plop, on a scale of 1 to 10, what is your feeling? And then we've got also 2 additional questions if you want to answer them. You don't have to. I also encourage you to use that real estate to convey a message to me. Or if it's a message maybe for Brent for this webcast in particular, you could put that in there as well. Use that space for that purpose. What I like to do is get your feedback and implement some of the things you're asking for in a session that we do right away. Okay, so that's what we're going through. So number 1, a survey. Number 2, subscribe. And I was going to just get to this last slide there. And make sure you're following us, right? To get those little nuggets during the day. Now, this is certainly not the only way you could trade long options, but it is an approach if you wanted to put in kind of some extra steps to help minimize our exposure to time decay, help minimize a little bit that volatility. If we, I was going to say, maybe not volatility, because volatility, if it goes up, that helps the price of the option, but just having a little bit deeper in the money to help avoid those whipsaws. All right. Thank you so much, everyone. Scott, thank you for your help today. These guys made you really busy. Yeah, they kept you busy. All right. Coming up next is getting started with technical analysis. That'll be right at the top of the hour. So take a quick little break, get a snack and a drink, and we'll see you back here in 15 minutes. Thanks, everybody. Bye-bye.